Welcome to the Way the Renaissance Man podcast starring Jim Woods. We hope you enjoy this reprised interview of Jim with the WallStreetReporter.com.
Good day from Wall Street. This is Jack Marks for Wall Street Reporter, and today I am speaking with Jim Woods. He is the editor of two newsletters. One is Successful Investing and also the Intelligence Report. And Jim is ranked as one of the top analysts worldwide by TipRanks. And Jim's success rate, according to TipRanks, is in the neighborhood of 75%. So, Jim, we're glad to have you today.
Thank you so much, Jack. It's a pleasure to be here, and thank you for having me on the show.
Absolutely. So, before we kind of get into, your outlook on the markets and get into some specific picks, can you kind of give us a little bit of background about your two newsletters and, sort of the investment philosophy?
Sure. The two, I consider myself kind of, a fortunate heir to two highly successful, highly respected newsletters. The first newsletter, which I've been working on since around 2004, is called Successful Investing. Now, before it became Successful Investing, some readers might remember it, or some of your listeners might remember it as the Telephone Switch newsletter, which was a publication that goes back about 4 decades, and it was started by a great guy named Dick Fabian. And the Fabian name has been around for quite some time in investing. He had the newsletter for 25 plus years or so, and he handed it down to his son, Doug Fabian. And Doug Fabian operated that for many years, and it was with Phillips Publishing, then it was with Eagle Publishing, which is where it is now. And a few years ago, Doug decided to retire from the newsletter industry, and I had been working with him as his right hand for about 14 years, so I was familiar with the theory, and I had basically written almost everything that we'd put out together for those 14 years. So I became the intellectual heir, if you will, to the Fabian plan and the trend following philosophy that goes into successful investing, and I'm quite honored to carry on the legacy. The other newsletter is the Intelligence Report. I inherited that about a year and a half ago from the great Dick Young, who was a maverick kind of market investor and really smart guy that helped a lot of subscribers over the years. He decided to retire from his newsletter publishing business, and I inherited that publication as well, although I didn't have any direct contact with Dick or anything like that during it, but we kind of had the same political economy type of ideas and the same basic kind of maverick, if you want to call it that, ideas about some things. Right. So it was a natural fit. So that's where we stand now. I actually also have another publication called The Deep Woods, which is my free e-letter. So that's something that any of your listeners can go right away to and check out. There's a lot of stuff on politics and philosophy and investing, and that's one of the things I like to do. I like to incorporate all kinds of different areas of knowledge into both my stock picking and my writing when it comes to like the economy and markets, because you got to understand things. The way I see it, you have to understand things in principles, not just what's this going to happen, what's that going to happen. And the principles is something that I always go back to, because if you have good premises, good principles, you're going to have good results. Bad premises, bad principles, bad results. Or if you're just throwing darts at the board,
so
you're not going to have good
results.
It's
a holistic approach.
It's a holistic approach. It's an integrated approach. And although the focus between various newsletters and various ways of approaching the market might be a little different depending on whether the person feels more comfortable trading. They might be more comfortable doing options. They might not want to do options. They might be investing for income more. They might be investing for long-term growth. They might be investing just to protect their nest egg. I got something just about for everyone throughout the different newsletter
So right. So I've looked. So in the current issues, you cover everything from ETFs to income to more aggressive picks. I guess right. Everything in between.
Right. Yes, exactly. And that is, for example, in successful investing, that those what we have as of current is actually quite limited in terms of the exposure, because the essence of the successful investing newsletter is that we're a trend following system. So we look at the wider market as a whole, and we see where that market is relative to certain key moving averages, and where the market is. And when I say market, I'm not just talking about the S&P 500 or the Dow. I'm talking about our own specific way of measuring the market, which we use several ETFs to do that, and we put them all together, and it gives us a better picture of the market. We call it the domestic fund composite. So we use that domestic fund composite, and we look at where the market is relative to the 200-day or 39-week moving average. And that will tell us when we should be in the market or when we should be out of the market.
Okay.
So
Jim, I'm sorry. So the system is based on a moving average. It's a trend following system based on moving averages then, yeah?
Yeah, that's correct. That's
okay.
Right. I mean, so just to give you an example, we got out of the market as a whole. We got a first sell signal since earlier in the year, and that was on October 12th. So everybody knows, I'm sure your listeners and you know.
It's good timing.
The carnage we've seen, it's relative carnage, since that time. It's like, for example, the Russell is down about 11% since that time. NASDAQ Composite's down about 10%. And the S&P is down about 8.5% since that sell signal. So we managed to sidestep the majority of that selling, although we still have a few tactical positions. We managed to sidestep that because we knew that the market trend was overwhelmingly negative. So think of it as kind of a more specific version of like a Dow theory. That's how we go. And a lot of people say, well, yeah, the Dow theory hasn't got a sell signal in a long time. Well, it got a sell signal on December 7th, depending on exactly how you measure it. So we were about a month or 2 months or so before the Dow theory actually got that sell. So we preempted the Dow theory by nearly 2 months, and saved readers a lot of capital by doing so.
And this is based on what is it, the Fabian system, yeah?
Yes, that's exactly right. It's based on and the other thing too about this system is it's not something that I just kind of thought up in my laboratory in the last couple of years. This is something that's been proven to work over the last 4 decades.
So back even in the Louis Rukeyser Wall Street Week era.
Even when Wall Street Week was the top-rated financial show, it was the only financial show.
So anybody under the age of 50 probably won't get the reference, but we'll go
okay.
with it.
Yeah, we'll have to teach youngsters the reference.
Yeah, I remember watching Louis Rukeyser, when I was in my teens. So
yeah, it was funny when I was a kid.
Marty Zweig and all those guys.
Yeah, exactly. Those, I mean, there was no basic financial TV. There was some local stuff that was in the LA area where I'm from, where I reside. But there was no mass CNBC or anything like that. It was before that time. And the only thing you could really read was the Wall Street Journal and later Investors Business Daily, which is a publication I highly recommend. I'm partial there because I spent about 8 years working there. So, but those were the only sources of material. And I recall as a kid when I would watch some of these shows, like I would watch like Wall Street Week, the old Louis Rukeyser, and I watched Firing Line, the old political show with William F. Buckley. And I was pretty young, and my mom was like, "There's something wrong with this kid. He's reading the Wall Street Journal and watching Louis Rukeyser, and he's only about 9 years old. What's going on?" So she knew I was destined to do this type of stuff for a living.
This is it. Now, and you worked with was it William ONeill at Investors Business Daily then, yeah?
That's correct. I was one of many people that worked with him, but I did work with him fairly directly on developing the course materials for lessons in the what he calls the CAN SLIM trading philosophy, which is a philosophy that's it's a momentum and fundamental philosophy that identifies stocks as they're trending higher. And many of the principles that I learned from Bill ONeill and that I wrote about back then, this was like mid-'90s or so, are things that I use to this day in my trading services. So,
I mean, they're both essentially trend following systems.
Well, yes and no. I mean, in a successful investing, it is definitely a trend following system, but we don't take into account, stuff like price earnings ratios and things like that, because it's more of a macro position on the markets. So it's kind of, you're in the markets or you're out of the markets, and of course where you end up going in the market depends on a lot of other. That's where the part of it comes in. Which sector ETFs are more likely to do well? Like, for example, at the beginning, right around the late 2016, when Trump won the election, we allocated to things like defense sector and technology and those kind of stocks, because we knew that those kind of stocks would probably do well under a Trump-oriented kind of economic and regulatory environment, and that's exactly what they did. But then once the market told us to get out, we sold those for big gains, like in the case of the defense stocks, over 40%, in about a little less than 12 months. So that's the kind of like focus that we put in a specific way. But now, when you're talking about the ONeill kind of style, or the trend following there, yeah, it is partially trend following on the technical side, but then you also have the fundamental side, where you're looking at earnings growth, where you're looking at not so much price to earnings ratio, but you're looking at other valuation metrics that show that the revenue
Right.
growth and earnings, things like that. So that's where the stock picking art comes in of it. And that's not as present in the successful investing universe, although it is present. That's more my trading service type stuff.
Okay. So successful investing, do you mostly focus, I think, on what, ETFs?
Yeah, we've mostly focused on ETFs for maybe the past, I'd say the past, 10 to 12 years or so. And the reason why is because ETFs have just become a way more convenient, way more tradable, way more cost-effective way of getting exposure to market segments. I mean, you can get exposure to the S&P 500 through like the Vanguard ETF, the VOO, and that, I mean, when the market starts coming back, and when we're looking to get back into it, I mean, that's about as low a cost. It's like a 0.1 expense ratio or something like that, something ridiculously low, and maybe even less than that. I haven't looked at it lately, but that gives you like really low cost exposure to an index fund. So, for example, we used to have to buy like the Vanguard mutual fund to get just general exposure. That was always a little bit more expensive, even though that was low, and there were no loads. So we kind of went, over the last couple of decades, we've gone from expensive mutual funds to no-load mutual funds to very cheap ETFs and very easily tradable ETFs, where you can just click on your, with your electronic account, and you're in it.
Right. You get that instant sector exposure.
It's instant sector exposure. It's simple. You can look it up easily. It's priced in real time. There's not really any kind of, there's not much of a NAV difference depending on the fund you're looking at. And over the last 10 years, of course, especially in the last 4 or 5 years, you've seen an explosion of different sector-type ETFs, what's so-called smart beta ETFs, which I like, and just different targeted ETFs that can do. You can short the market. You can buy gold. You can buy precious metals. You can short those sectors. You can buy the dollar. You can buy oil. You can buy anything out there basically that you want, and especially the international type of stuff, because back in the day, so to speak, the international markets were more expensive to buy into through mutual funds. But with ETFs, you can allocate to any country you want for a pretty cheap price. So that's why we use them, and they're transparent, and there's all kinds of reasons to like them. There's a few reasons not to like them. Sometimes they can open up at a mispriced kind of level, and that did happen a couple of years ago. But for the most part, there's way more advantages to using ETF.
So you basically got out of the market, or you got a sell signal in early October, but you mentioned you still have exposure to a couple of sectors or a couple of positions, tactical positions you mentioned?
The tactical positions, we have, again, it depends on what your focus is. So if you're a growth investor, right now we have a small cap growth, like a core small cap fund that's in the portfolio that has not performed well because of the market pullback. But when the market does come back up, I think that's going to be one of the first sectors that does, because it's been beaten down. So we're holding a small allocation there as tactical.
And what's the name of that ETF?
Small cap, the iShares Core S&P small cap ETF.
What's the symbol?
IJR.
IJR.
India.
Okay.
Yeah, India, Juliet, Romeo.
Okay, and that's kind of like a placeholder for when the market rebounds?
Yeah, exactly. Now there may come a time when that fund doesn't meet my criteria, so it might be out. But so far, it's still above its what I call its exit point. So we're riding.
And what? So let's get into your other letter, the intelligence report. I think you had. I'm looking at your current issue, and you kind of open up with sort of the macro picture, for your subscribers. Can you kind of share with our audience what your current perspective on the macro picture is?
Yeah, the macro picture. Macro picture is difficult right now because in the last few weeks we've seen, since the beginning of earnings season, in Q3 earnings season, which was just a couple of months ago, we've seen a couple of negative developments that I think are somewhat threatening to the market's future. Now, so remember that we've had a big bull market, obviously, the last 9 years. But particularly the last couple of years have been extremely strong. Part of that is the kind of Trump tailwind of tax cuts and regulation, which I still think are there, although they're going to be limited. The further we go out, the less effect they're going to have. But this market's been built on two strong pillars. Okay, earnings growth on the one hand, and the other big pillar has been economic data, strong economic data. So for the past couple of years, we've had earnings growth and strong economic data. Now, the first pillar that started to weaken was the Q3 earnings numbers. Those were disappointing, to say the least. Even though many companies beat on the bottom line, the top line was generally a little weaker than expected. Plus, a lot of companies reduced their forecast for 2019 and for Q4. So that hurt. There were some high-profile misses. That hurt things on that side. So the kind of the one big pillar started to shake a little bit, and of course you started to see the market turn down when that happened. Then the second big, fundamental pillar is economic data. And that was pretty good for most of the year, but now we're seeing that data start to quiver a little bit. We're starting to see, China earnings, our China economic growth come way down. Part of that's maybe a result of this whole trade war thing, which we can get into later if you'd like.
Sure.
And then the other disconcerting thing is recent economic data has been weak. Housing's been weak, and just even last Friday we had the Empire Manufacturing, which is not usually like a significant report, but that missed expectations. That confirmed that the PMIs in the Purchasing Managers Index, that was weak, and both on the consumer or the production side of it, and also on the consumer side of it. So, there's a lot of cracks in the mirror, so to speak, and so you add the earnings weakness with the fundamental weakness of economic data, and then you add to that a Fed that is still hiking rates, which I think they will on Wednesday. It depends on when your listeners hear this.
Yeah, this is tomorrow. That would be December 19th.
So right now, if you're listening to this today, you don't know. We don't know yet whether the Fed is going to hike or not. I personally think they will, but they'll do what's called a dovish hike, meaning they'll hike because they kind of have to, and just to save face in the front of some political and data issues. Although the Fed's funny right now because you can make a good case for the Fed hiking, or you can make a good case for the Fed not hiking. It's not a cut and dry situation like so many Fed meetings have been over the last.
What about, or is there consensus that they're going to raise it? I don't know, maybe a quarter point, and then no more. That's it for the next year. That's a possibility?
That's a possibility. My take is, we'll find out tomorrow if I'm right, but I think they are going to hike tomorrow or on the 19th. Quarter point is expected, but they're also going to signal that the economic data of late has been weaker and that it's slowing, and that the Fed funds rate then now would be about neutral with inflation rates, so that they're basically going to say, hey, we're going to remain data dependent. Okay, that's what they always say, but when they say it in the statement, you got to know how to read the Fed tea leaves. I consider myself an amateur Fed watcher, but amateur Fed watcher is everybody else too, because no one really knows what's going to happen. Even the people on the Fed are amateur Fed watchers. So I think they're going to signal that dovish rate hike, meaning they're going to tell the market we're not going to be as aggressive. We're not going to just keep on hiking at the pace that we're hiking through 2019. Because right now, the market's pricing in about 2 hikes, maybe in some cases 1 hike. I wouldn't be surprised if by the end of the week or by the end of tomorrow's meeting or the Wednesday, the 19th meeting, that the market prices in like maybe 1 rate hike next year. That could be you could actually see stocks do really well if that happens. If the Fed decides to not hike rates, you're going to really see the market go up. So that could be some unexpected tailwind to the markets. There's a lot of other things on the macro front. On the macro front right now, you've got a lot of headwinds, like the 2 pillars that I mentioned that were struggling. But you also have other headwinds like the Fed, and we'll find out if that's going to continue to be a headwind. But the other one you have, of course, is this, what I call this crazy trade war. It's an insane, anti-American trade war, if you will, because the idea behind it is we need to punish other countries, other people, and we need to buy our American, like as if Americanism was based on the nationalism of buying your country only. And America was based on individualism, free choice, free trade, free exchange, the best price from whoever that might be, the best product.
Free markets.
Freedom of the citizens to make their own independent judgment. That's how the country became the country. It wasn't because of central planning. plenty of countries in the world had central planning and never did anything. And mercantilism and all these other kinds of failed mixed economy situations, including China. China didn't even start getting big until they actually started adopting some capitalism. So the trade that we have with other countries is a net positive for us, and the idea of putting trade barriers on to save jobs in certain areas, or to manipulate, or to punish, or to lash out at all that does is punish the American people. It's a tax on us. It's going to pressure earnings if there is a trade war. There is a trade war, but if the salvos get heavier, that's really going to hurt. And I think it's really bad. Now, that's a big tailwind if that continues to take place. But we've also seen a lot of progress on that lately. The whole President Trump, President Xi summit that happened recently, that was a positive thing. There's a lot of rhetoric there, but China decided to reduce tariffs on U.S. autos, and they're buying soybeans from us now, and they have agreed to they're kind of putting a pause button on that made in 2025 kind of policy that they have that essentially targets like technology.
So Jim, how do you square free trade with fair trade?
Well,
it's a balance.
That's
right?
a great question. Here's the thing. There is no such thing as unfair trade. Trade is trade. If I go to the store and I buy something from Walmart and they sell it to me for 15 cents or whatever it is, they get my money, I get the product. Who loses? The concept of that's the whole thing I want to try to make people aware of is when you're trading on a basis of voluntary trading. You're buying a cell phone from Apple. They're buying, Chinese are buying, soybeans from us or whatever. Where's the unfairness of that? And you could say, well, there's the tariff thing and the government gets involved. Yeah, the government part could skew the kind of the playing field. But guess what? The idea of a fair playing field only really matters when you're talking about games that you construct, like football or baseball, whatever. It doesn't really apply to business because there's always going to be people that can supply a product better than other people can supply a product, or cheaper than other people, and that should be up to the citizens and the companies that do business to do that. Now, people talk about intellectual property theft. Okay, yeah, that's a problem, but that's a problem that a company has to. If you want to do business in China, you better be prepared to give up your IP because that's kind of how they do it. So if you want their access to their markets, that's kind of the trade-off that you have to have. Like if I had some kind of IP type product, I wouldn't want the Chinese to steal it from me, so I wouldn't go there and try to do business with them either. So that's, but that's a different story. It's kind of up to thing. It's a tough problem. I'm not saying that there's an easy answer, but the concept of trade being like either fair or unfair to me doesn't make sense.
So what about the in your newsletter you talk about the bullish gridlock theory, which in theory is very bullish for 2019. Can you kind of get into that and tell us some of the statistics which are quite interesting, which you talk about in the letter?
I mean, it's okay. So the gridlock is first of all, I'm very libertarian oriented, as you may have gathered already.
Right.
But so to me, the fewer things that so-called quote unquote get done in Washington, the better. And that means that gridlock is good, in my opinion. So gridlock meaning divided government, Democrats in the House, Republicans in the Senate, and Republicans in the White House. because I don't want any big kind of, infrastructure spending things, and I don't want this law and that law being passed. I want the markets just to be left alone, and that's probably going to happen because you're not going to see any kind of big. I mean, we already got the tax cuts, and there was no real second round of tax cuts on the table. I mean, there was some talk about that, but there wasn't really anything. But it's interesting because the gridlock is good thesis is not just something that, like, if you have a certain political mindset on. The gridlock is good thesis actually is borne out in the historical analysis. So, for example, since 1946, there's been 18 midterm elections. So in the 12 months following each of those elections, the markets rallied really sharply. So fully 100% of the time, stocks have been higher 12 months after the midterm election, but not just a little bit higher. The average is 17% higher.
So every time, every midterm election, it's been 17% higher since World War II.
Yeah, well, that's precisely right. Now, the average is 17% higher.
Okay.
It's not every time it's been 17. It's been
right.
Higher and lower. But yeah, so I mean, if we're going by historical norms, which of course can always be wrong, we're looking at a better year in 2018, a higher year for the S&P. But of course, if we base it on relative terms, even just a small gain would be higher than what we've had so far, because year to date we're in the red. But we're talking about materially higher in the following 12 months. And I mean, for some, I think the basic idea behind that is that the political kind of equation is off to the side, and the market can get back to focusing on what they need to focus. And that's been especially true in, say, in the last couple of decades, because the market's been more influenced by politics in the last couple of decades than it's ever been before, especially the last 7-8 years.
Sure.
We're looking at at least from a calendar's perspective. And also, I don't know exactly the number off the top of my head, but the third year of a presidential administration is traditionally the strongest. So we've this time around might not be, because the first year of this administration was extremely strong.
I was gonna get into it because traditionally the first year is usually terrible for markets.
Yes, that's
stocks,
exactly right.
And this is one of the best of all time.
Yeah, no, you're precisely right on that. The first year, 2017, was a tremendous year, as you know. It was S&P up about 25 something percent. I don't recall exactly, but and then of course this year has been the second year, which has not been good. Although we were doing really well, hitting new all-time highs, up until a couple of months ago. So it wasn't like there wasn't money made. I think that's actually some of the reason why, because we've had a couple, almost 2 years of rollicking markets. Well, basically 2 years, from 2016, from November 2016 till about October 2018, market was doing real well. But then, we started to see those kind of pillars weaken, and then we started to see the Fed start to signal that, that it was going to keep putting the gas pedal on no matter what. And we saw people worried about the political equation, and then we saw people worried about maybe even this kind of whole Mueller investigation thing. There's a lot of there's a lot of reasons to just step aside and say, and then there's situations like in our Successful Investing newsletter where we get technical selling triggers, and we're not the only ones who get trend following technical signals. A lot of algorithmic trading on Wall Street is driven by that type of thing. So while not maybe the same exact as the way I do it, a lot of stocks have fallen below 50 and 200-day moving averages, and they keep on selling off right there. So it's no secret that we've that we, it's not a surprise that we've seen a lot of stocks in the market go down. Now that said, there's still always good stocks out there to find. There's always like diamonds in the rough, so to speak, and there's always gems out there.
Let's get into that. How are you positioning your subscribers in the intelligence report right now?
Okay, so intelligence report. Now keep in mind, intelligence report is our philosophy there is buy great stocks, hold them for as long as you don't need to cash them out for another reason. So we're a long-term investors in that newsletter. We love owning quality stocks at quality prices. So for example, McDonald's, P&G, Caterpillar. Now some of these stocks are not the sexiest tech stocks, but they're the stocks that have delivered over the last several decades and have grown their dividends over multiple decades, some case 5-6 decades, and we own those kind of stocks. So right now, if you have money to add to your portfolio, the stocks that we recommend in that service are at a discount. You're licking your chops right now to own some of these stocks. I mean, even a stock like Johnson & Johnson, which is down. It was up huge over the last couple of years, and it's one of the best companies out there. Now, of course, they had that whole kerfuffle on Friday about is there asbestos in the talcum powder, and so the stock went down 10% one day. And then the following Monday, that was last Friday, following Monday it went down another 3%. Today, on Tuesday, it was up another 2%. So the stock is rebounding a little bit. I mean, right now, if you have long-term capital to invest in, that's one of my favorites right now, because you're getting a great stock at a super, to me, an unfairly discounted price.
So that's Johnson & Johnson.
Yes, J&J, of course, is the symbol.
Okay,
so that's those are the kind of stocks we like there. I mean, these are and not only that, but this is if there is some wider kind of recessionary developments in the economy in the coming year. I don't think there will be, but if there is, that's the kind of stock that's going to outperform.
What are your favorite stocks for 2019? Given the kind of the current situation where you have some headwinds, but you do have at the same time these sort of statistical probabilities of a higher market.
Right. No, that's a great question. Yeah, in a market. There's two things I look for in a market like this. Well, basically in almost any market, but there's two things that really matter when. I mean, anybody can buy nice momentum growth stocks when the market is trending higher. It becomes a much easier task to identify the big momentum movers, of course. But there's a few stocks that are doing well because they are growing their businesses organically, and because they are trending higher on some kind of new development or some kind of positive news or some kind of positive attribute that they have that they're outpacing the competition on. So, for example, this was one of my favorite stocks of 2018, and it turned out to be an incredible performer. And it's a stock that I think is going to continue to just kill it. This is my no-brainer gimme for everyone here. It's a stock called Planet Fitness. PLNT is the ticker symbol. Now, this company owns and operates fitness chains, gyms, and they do it at they call it a no judgment gym. And in other words, it's an inexpensive way for people to go to the gym, work out, and they have a really good facility with all the latest equipment. Customer service is incredible. They don't have any kind of it's like fitness. It's a good, cool fitness place for the masses. And in the I'm into fitness myself, and the company itself is basically delivers what people need in a gym.
Are they
And
are they a national chain?
Yeah, they are a national chain, although, depending on where you live, you may not have access to a Planet Fitness. But I think, let's see, I know they're East Coast based, but they also have they also operate their gyms as a franchise too. They have some store-owned and some franchise-owned locations. So they're in the U.S., Puerto Rico, Canada, Dominican Republic, I think also in Panama. I think they had about 1,700 stores. Well, they call them stores, but gyms. I think in all 50 states. Last time I looked, and multiple locations in different states. So, the chances you living near one are probably pretty good. I'm sure there's one in New York City.
So what's their competitive advantage? What is it that you like about the stock?
There's two things I like about the company itself. Their customer service. They're always ranked one of the best customer service providers in the fitness industry. They're always the highest ranked. They offer really cheap value, or really good value on the memberships. I don't know the exact price of the memberships, but I think it depends on where you're located and where you're, what kind of package you get. But it's one of the most cost-effective ways of owning a gym. Like it's $20 a month or something like that, and so people don't have to break the bank to go work out.
Okay. I'm looking at the chart here. It's a tremendous uptrend from the past 2 years.
Exactly. Yeah, the stock has done really well. Last couple of years has done really well, especially this year. Now, since you mentioned the chart, I'll look at that as well. Now, you can see, if you look at a chart, the daily chart's good to look at, but it's also kind of almost easier to look at the weekly chart if you're looking at a longer term. And, it started about a year ago, it was in the 20s. And today, about a little under $54. And that wasn't even the high. The high was, I think, almost $60. And of course, it's pulled back off the high slightly in the last, say, couple of weeks when the market tanked. But I mean, it's still way above its.
Yeah, it's just just slightly off the highs after all this market carnage.
Exactly. So that's the kind of pocket of strength that I look for, and that's the kind of stock that I in addition to the other two services you mentioned, I have a couple of trading services. One I do with name some people might know, probably do know, is Mark Skousen. And Mark and I operate a service called the Fast Money Alert. And we pick stocks like Planet Fitness. We also use options in this way to enhance the gains there. And actually, timing-wise, it's fortuitous to announce this on Thursday. I have a new service that's debuting called the Bullseye Stock Trader, and stocks like Planet Fitness are the kind of stocks we're going to be looking at. So even when the market is not doing well, there's still pockets of strength out there. Now, when the market is doing well, there's a lot more pockets of strength. There's a whole wave of strength, but you can't always bet on bull markets to get winners. So you got to find the strength where it comes. Now, when you're looking for the strength, you're looking for companies first and foremost that keep on earning money and keep on growing their bottom lines, because you want revenue growth, earnings growth, and you want that from recent quarters. You also want that over a period of years. So in other words, a company that is not just some .com kind of thing. You want a company that's actually delivering, making money for its shareholders. Then you want to make sure that the technicals, you want to make sure Wall Street likes it too. And that's where the technicals come in with charts and with, different volume analysis and whether it's a good time. There's different, we call it bullish chart patterns and bearish chart patterns. Sometimes a good company is great, but you can't get into it because the chart pattern is not good. Like there's several companies right now that I like, but just based on the pullback of late, I wouldn't want to buy them right now because I want to see that they can come back when the market comes back.
So Jim, like Planet Fitness kind of, it fits well into your kind of your thesis, or what we talked about for 2019, where you have these the headwinds, but you still have this statistical probabilities. I mean, this is almost, would you call it a defensive stock plan? I mean, because it's a consumer stock, but again, because they're offering very good value. Is that kind of?
I mean, you could. Traditionally, it wouldn't be considered a traditional defensive.
A consumer staple almost? I mean, these days, fitness is almost a consumer staple.
That's a very good point, Jack. I think you actually, you just gave me a good little talking point for Planet Fitness. Because, and thanks for that. I'm going to borrow that if I can.
Just give me some royalties.
Right. Well, I already gave you the tip, man.
Oh, that's okay. That's a fair trade.
So, that is a great point because fitness has become a kind of consumer staple.
Certainly where you are in California.
Yeah, I mean where you are too. You're in the city. I mean,
yeah.
There's a lot of fit people walking around, a lot of workout places, a lot of personal trainers, and in Manhattan. But I mean, it's not a traditional defensive such as like J&J or such as like Procter and Gamble or another stock that I like. I'll give you another name that I like a lot. McCormick and Company. They're the spice company.
Okay.
Probably you go into your spice cabinet, you do any kind of cooking, you're probably going to find something from them. Or if you go into any restaurant, usually they're the ones who supply the spice. That company has done extremely well over the past several years, and that's the kind of company that's growing earnings. They have not pulled back significantly during this downturn. I mean, they've pulled back a little bit, but they still remain well above the long-term moving average and well above, even above their 50-day moving average. So it's kind of a growth stock. This is one of those stocks that trade like a growth stock, but that earn like a defensive stock, and that's another kind of thing. And then these stocks aren't the easiest things to find, but if you know what you're looking for, you can find them.
So that's MKC.
That's exactly right, MKC.
And there's even a small dividend right now.
Exactly. Yeah, that's an added benefit. And if you're a long-term investor and you're following like kind of a build your portfolio for the long term, you want stocks that pay a good dividend and that also are earning. That gives you the best of both worlds, the dividend and the share price appreciation. That's kind of the holy grail behind finding the.
Anything else that kind of fits that criteria for 2019 that you have your subscribers in?
I like a couple of different stocks. I'm hesitating to give out too many.
Right. We have to save that for people, when they subscribe, and we'll get into that. If you want to give one more, we'll leave it at that.
Okay, so here's a stock that I like right now, especially if this market continues to falter. It's a company called Kirkland Lake Gold. KL is a symbol. Now, Kirkland Lake.
I actually own that stock as a disclosure, a little small position.
There you go. Well,
what do you like about Kirkland Lake?
Kirkland is the good thing about Kirkland is their earnings. They're one of those companies that knows how the mining operations that they have are like killing it on the earnings per share growth. So as opposed to a lot of the other companies are not in that segment are not doing well. I don't know if it's underperforming mines or just not the right kind of mines, but they are the kind of company that just is in the right place to extract this stuff. And then if you look at the fact that the shares are doing well because of partially a flight to safety, partially an earnings play, and partially just a great company kind of play, then you have another double whammy right there of positivity. So, and especially if the market starts to get, testy here even further, we start going into like a full-blown correction, a full-blown bear market, then we're gonna need to have stocks like that to ride.
Now, actually, I'm looking at Kirkland Lake. I didn't even notice this. It made a new high today.
Yeah, 52-week high.
52-week high. Wow.
Yeah, it was up almost 5% in today's trading, and that makes sense because if the market anticipates a dovish Fed, then that's going to be bullish for gold prices, and hence you're going to see people run back. It's also going to be bearish for the dollar, which is good for gold as well.
Are you a fan of gold, or are you kind of neutral?
Philosophically speaking, I think gold is really the gold standard is the only sound money. That's what we should be on the gold standard, but those are what we should be doing and what we are doing are two very different things. I am a fan of gold from as a part of everyone's portfolio. I think gold does deserve a slot, 5%, 10% allocation, depending on what you're doing. I don't like the idea that you should go out of that you should just be 100% gold, or that the civilization's coming to an end and we need to buy gold coins. I'm not an advocate of that perspective.
You're not a hardcore gold bug, basically.
I'm not a hardcore gold bug, although the argument for the gold standard and for gold is definitely sound, which really means an argument against the Fed and against the price controls that the Fed is charged with setting on the cost of money. So the price controls are never a good idea, because it goes back to what I was saying earlier. It's a freedom thing. Why should a government or quasi-government kind of agency make the price of something? Let the market decide the price of something. That's what it should do. So if you had bankers, they decided to loan a certain money at a certain rate, that's how it should be. But of course, that's not how it is now. So, I'd like that. If I could wave a wand, I would just wave it in the kind of in the service of freedom, as it were. But we have the reality. What we have is how we have to navigate these things, especially when it comes to money. But yeah, gold is definitely something that I conceptually like, but just like any other stock or any other sector, you need to see the positives forming, and then you can say, okay, now it's the time to be in this, or now it's not the time to be in this.
So you gave us looks like three, including actually four very compelling stock picks. McCormick, Plant Fitness, Kirkland Lake, Johnson & Johnson. Would you consider that? You're still positive on Johnson?
Yeah, I definitely think that's
okay.
For all the reading that I've been doing about this whole asbestos thing. Now, of course, this could turn out to be not the case. I could turn out to be wrong, or this could be a situation where the company is in a lot of legal jeopardy or lawsuit kind of jeopardy. I wouldn't be surprised if that was the case. But a company like J&J can weather that. They've got plenty of money set aside for legal issues and things like that, and plenty of good lawyers on their staff. So it depends on how it materializes. But certainly a 10% sell-off in one day on a stock that powerful, that good, a company that good, just based on some reports, which were contradicted by a lot of other reports, scores of other reports, saying that the company knew about asbestos being in the talcum powder that they use. I mean, that's I'm not convinced myself on that. I'm not a scientist. I don't know how that whole situation works, but it certainly seems like the algorithms and the people that just kind of overreacted to the headlines on that one. So you can't get, when you're investing, you have to pay attention to headlines, but you can't get overcome by headlines.
Okay. So Jim, how do our the members of our audience find out more about your newsletters? Are there trial subscriptions? Where do they go?
Certainly. Well, the best the central hub is just go to my website, jimwoodsinvesting.com. And from there, you can sign up for the e-letter, the Deep Woods, and that's free. Or you can check out the Successful Investing newsletter, Intelligence Report, Fast Money Alert, and the Bullseye Stock Trader, which is, again, premiering on Thursday the 20th. You can see all the writings that I have on that. If you decide to subscribe to any of those newsletters, you'll see you get all the hotlines and the monthly reports and all the analysis similar to what we've been talking about over the last 45 minutes or so. And that's the best way to start, jimwoodsinvesting.com.
All right, so jimwoodsinvesting.com. And Jim, I want to thank you for your time, and I'd love to catch up with you again sometime in the next few months.
Definitely, I'd love to do it anytime.
Thank you.
Thank you, Jack.
Thank you for listening to this reprised interview of Jim Woods on thewallstreetreporter.com. For more great resources, please visit the website at wayoftherenaissanceman.com.